Good afternoon, everyone. Dan Gerard, Managing Partner, G9 Financial. Hope everyone's had a great 2023 so far, and you've enjoyed some of the summer weather. And as we move into fall here, some of the nice fall summer weather. I'm here with two partners of ours from Clark Capital, Ryan Gardiner and Brian Fitzgerald. We've been working with Clark Capital now for several years, and they've been kind enough to come on this morning and give us an overview of 2023, of kind of where we went, where we're going, and kind of give a sentiment of where we're at regarding the markets in general. So with that, Ryan, I'd like to hand the ball over to you.
So sort of with the economic view, a great starting point for us at Clark Capital is looking at our economic gauges. Here we focus on a high-level view of the macroeconomy, what's happening with these 5 gauges, and clearly we underpin that with the underlying strategies who are more bottom-up versus this being a top-down approach. So as a reminder for the gauges, we do update these quarterly. The central point is neutral on each gauge, and anything to the right is regarded as a positive for stocks, and anything to the left is regarded as a negative. So think of it as a headwind versus a tailwind. And what you'll notice on screen is, of these gauges, the one that did actually change for the quarter was that of investment sentiment. So for the purposes of today, I'm going to focus on the economy, monetary policy, and investor sentiment in terms of the update for what's happening. So looking at the economy and where we are with the labor market. Now, there's not too many good surprises in life, but one of the good surprises this year certainly has been the robustness of the US labor market. We've continued to see the number of new jobs coming into to the labor market. And what that's done is that's really brought down US unemployment. Now, the low level we reached actually 2 months ago was 3.5%. We last saw that in 2019. And we actually have to go back to the late 60s, so over 50 years ago, where we last saw these levels of low unemployment. And then recently, we've actually seen a print of 3.8%, so unemployment slightly ticked up. Now, that's can be quite confusing. The reason for that is the number of jobs has actually increased over this time frame. Each month, we've actually had more than 100,000 jobs into the labor market. So the reason the unemployment rate has actually gone up is because more people have come back into the labor market seeking employment. And that's a good thing. We want to see unemployment actually tick up a little. And then I'll touch on the reason for that, because that's linked to monetary policy. So if you think of US employment, if we're employed as an economy, it means we're saving, we are spending those savings, and we're keeping the economy afloat. And should we go into a recession in the future, so in the next 6 to 12 months, by having low levels of unemployment, it helps have a cushion or a buffer going into that recessionary period. So really, it's a good starting point. You're entering a recessionary period in a position of strength. And that's why it's important. And what you might have seen in narrative from news anchors, financial commentators, you've seen things move from a hard landing for the economy to a soft landing. And then more recently, we've seen the probability even of a so-called no landing for the economy. And that's just what people are talking about in terms of GDP growth, how the economy is doing. But certainly from the labor market, that's been quite strong. And that's really keep things afloat. So Q1, we saw US GDP growth of 2%. And the second quarter, we actually saw a number of 2.4% growth in the gross domestic product, or GDP. So this is actually above long-term trend when we look at GDP growth.
And right, that would be a positive sign, I assume.
Yeah, that is very, very positive. And Dan, the reason why that is that helps drive earnings and valuations for stocks. So if you have good profits coming through, GDP is definitely a good tailwind to have for corporate earnings, which helps valuations of stocks. So the other thing with the labor market is we've seen the number of job openings. It peaked at about 12 million. At the beginning of the year, and now we're looking at a number of about 8.8 million. The number of unemployed is just over 6 million. So there's still more job openings than there are the number of people seeking employment. And that dynamic clearly is good for things like wage growth. It means productivity is good. And these are all very positive signs for the labor market. And I just want to spend time on that because that's why we are in a good position. Now, if you think back to 12 months ago, people were talking about a severe recession on the horizon. Jamie Dimon, CEO of JP Morgan, spoke about this economic hurricane or a tsunami, just talking about a severe recession. We've not actually seen that yet. And one of the good reasons for that certainly has been the labor market, which has been very robust and resilient. The next one I want to touch on is inflation. So down on screen, what we have here are three measures of inflation. So CPI, PPI, and then PCE. So these are just three different measures. The consumer in the blue is what you and I, in terms of what we experience from inflation. The red is the producer, so think companies, manufacturing. And then the green is what the Federal Reserve look at. That's just a different measure for inflation. So we just need to be aware that there's slightly different measures for inflation. But the overarching theme has been the big reduction from inflation over during 2023. We saw it peak, and we've seen that inflation come down very strongly, which is a very good sign if you think of the US Federal Reserve and what they're trying to achieve.
So Ryan, do we feel inflation could be flattening out a little bit here and stabilizing?
Yeah, that's a good question, Dan. So most of the heavy lifting's been done. It's been much easier to get inflation down from those high levels off the back of COVID. Supply chain has certainly, in a post-pandemic environment, has normalized. We've seen the effects of interest rates starting to come through by holding back consumption. So yeah, what we're looking at is probably a more sticky inflation environment, hovering at the 3% level is what we've experienced recently. So it's going to be a lot harder now to move it towards that 2% that the Federal Reserve is targeting. But at least it's nowhere near those levels of 8 to 10% that we experienced more recently.
Yes, with that we are thankful for that.
These are encouraging signs. Think about, so why I spend time on inflation and the labor market, because those are the two mandates for the US Federal Reserve. Maximum employment is what they're seeking, and price stability, which in essence is having lower levels of inflation towards their 2% target. So we're close towards that. We're heading in that direction. It's trending there. And employment, as I mentioned, is a good place. So that's a good way to then look at what are we doing for monetary policy. So we've experienced quite large interest rate increases since last year. So in fact, if we aggregate that together, if I add all the blue bars on your screen, and if I actually then just circle this area here, we also in the month of July had that 0.25%. So if I add those all together, it's 5.25 or 5.25% that we've experienced in interest rate increases. So that's why we have monetary policy as a headwind, one below neutral. This certainly is, interest rates coming off a low base is a headwind for stocks. But then, Dan, in terms of outlook, this is one I want to then focus on is, let's look at this period going forward here. So August, there was the Federal Reserve did not have a meeting in terms of interest rate policy. What they had instead was their economic symposium in Jackson Hole. Jay Powell gave his update actually 2 Fridays ago, the 25th of August, which is his annual speech talking about what they expect over the next year. So why I mention that is if we look at what the market is expecting for interest rates, we expect actually this pause area where the Federal Reserve has increased interest rates quite aggressively, so they hit the brakes, but now we're actually in the sort of neutral zone where the economy is just coasting along, but they're not yet accelerating, they're not hitting the brakes, they're just keeping it at this pace. And then the current expectation is then by, call it the spring going into the summer of next year, is actually the expectation for interest rate cuts is what currently the market's expecting. Now, the good news with Jay Powell's speech is that he's not on autopilot, he's data dependent. He's saying he's looking at the economy, he's looking at unemployment, inflation. So every time we see good or bad numbers, that's starting to impact what we're seeing for interest rates.
And so what you're pointing out here is really the current, and has been the government's plan to kind of help raise it, hold it flat, and then decrease it. That's been their mode of operation for at least up until now, and they're following through on it. Is what it looks like.
Exactly. So that's important. Now, why I spend time on that, Dan, is a lot of investors linking this to interest rates, because interest rates have risen in the short term. they are tempted to move money to cash. It's a natural temptation when interest rates are high. There is a tendency for some investors to be attracted to those high interest rates. So what we decided to do is let's look at previous interest rate cycles. So on your screen, you'll see the different cycles going back since the 80s of the difference between the Federal Reserve last raised their interest rates and then looking forward to what different asset classes have performed. So to give an explanation, so S&P 500 is the equity market. The term here, AGG, is aggregate. That's just an index for US government bonds and as well as corporate bonds. That's just a good benchmark for fixed income. And then 3-month bill is just a US Treasury over 3 months. So what we've done is we've looked at the peak of the final interest rate increase and then what returns have been 3 months, 6 months, 12 months thereafter. So the point I want to highlight is that on average, if you look at the bottom of the screen, which I'll highlight here, is that on average, most of the time, it's better to be in bonds and equities versus being in cash. And one of the reasons for that is the 3-month, if you think about 3-month Treasury bill, you have a reinvestment risk. 3 months later, you got to reinvest that money because it matures. And interest rates start coming down in the anticipation of Federal Reserve cutting interest rates. So if we look at what bonds have done, those have done quite well over different time periods. Now, this is an average. It's not to say it's a guarantee. If you look in the middle here at the year 2000, the dot-com crash, clearly the equity market struggled. The S&P 500 was actually in negative territory 6 months and 12 months after the final rate hike. So it's not to say it's a guarantee, but just to give an indication of, based on averages and probabilities, it's in your favor to still remain invested in both bonds and equities, despite the temptation of interest rates.
So in essence, stick with your plan long term.
Now I'm going to touch on the investor sentiment, Dan. So this is a great gauge for us to understand investor exuberance, fear, greed. So one of the indicators we look at is the American Association of Individual Investors. So these are not professional investors. So they wouldn't have the same access to analysis, research, and data, that we would get. But it just gives us an idea of what sentiment is. And the question that is asked is, what is the expectation for the stock market over the next 6 months? Now, we actually view this as a contrarian indicator. So on your screen, you'll see the numbers of 40% were bullish, so expecting favorable outcome for the market, neutral, hovering around 30, and bearish in the 20s in the red. Now, in the month of July, this spiked actually went to 50%. And for us, that was actually contrarian. And that's the famous Warren Buffett quote: when people are greedy, you need to be fearful. When people are fearful, you need to be greedy. And there's an element of truth to that for this specific indicator. And if I look at the bottom of the screen, you see the 60% bearish, which was almost the market low of 2022. And we just saw the massive rebound in markets. So this was for the end of June. We look at July, I mentioned it spiked. In August, we actually went through quite a bit of that volatility, which I want to touch on. Now, volatility, Dan, you and I know that it measures both upside and downside, but most of our clients and investors are more focused on the downside. Now, one analogy I like to use is it's the concept of flying. We're not nervous of flying, we're scared of crashing. And there's a difference here. So the same for equity markets. It's the downside that makes us more nervous than the upside. And we did not see much volatility for 2023 compared to 2022, just showing what anomaly it was. But it's healthy for a market to have this level of volatility. Risk assets are not expected to always go up in a linear fashion. There is an element of risk and volatility one needs to take consideration. So on that, I'm going to leave it for investment sentiment. That's why, in essence, we downgraded it 2 levels to the left. It is a sensitive gauge. It does move. It can move quite a bit based on the different data points. But in essence, that's why we did move that gauge towards the left.
And a lot of that, Ryan, is just emotions, right? A lot of that has to deal with emotions of the everyday investor. And we know that, the everyday investor, and you said it earlier, they tend to get a little bit nervous when things are going backwards and make decisions that may not be best for them long term. but emotions drive that.
Exactly.
Great. So overall, we think 2024 going and as we end 2023, head into 2024. I get the sense that we're on the right track, but what is your opinion of that?
Yeah, so one of the ones that's encouraging for us is we look at corporate earnings. So 2022 was an earnings recession. Earnings were lower for the S&P 500 if we look at the market. But if we look at this year, 2023, and going into next year, a 10% increase is expected for earnings for this year and 12% for 2024. So that's actually going to reach record high levels of corporate earnings for the S&P 500. And what that drives is generally in the long term, the performance of the S&P 500. So if earnings are reaching record levels, we should not be surprised to see the S&P 500 get back to those record levels as well. Again, these are long-term trends, but to your point, Dan, this is a reassuring data point to see how well corporations are generating profits in this environment.
Great. Well, Ryan, we really appreciate that overview. We get the sense again that we're moving in the right direction. It's nice to be able to access the folks like yourself from Clark Capital and Brian to rely on the professionals and those who are in the weeds of it every single day, more so than us, as we develop and we're working with those client relationships, be able to rely on folks like you guys at Clark Capital, the Brian and yourself, Ryan, to help us out, to help our clients. So we thank you for that. And we thank you for your time today.
Great. Thank you, Dan.
Thanks, Dan.
Awesome. Thank you guys so much. We appreciate it. And we'll